We start the video today or reading from questions that we have. I first wanted to talk about the Fulton County DA, Miss Willis. She stated during her testimony that her father taught her, and she recommended to all young ladies that you keep a lot of cash in the house. She said she would have between $5,000 and $15,000. I just wanted to make a comment on that. I would never keep that much money in my house. And the reason why is that $15,000, you can invest something as simple as a T-bill, a U.S. government T-bill, and you'll make $750 a year. So instead of having that money sitting in your house, I would have that money putting to work for me. That's just be my recommendation. So for the reading of the day, from one of my sons, the question was, if you're attempting the culmination for the first time, would you recommend buying T-bills first or waiting until the first equity pullback? As the equity pullback has more upside. Furthermore, roughly what percentage of your capital should you allocate to your each culmination rotation? If an investor has $5,000, what percentage that should be invested in the first rotation versus being kept on the sideline in preparation for the next rotation? So that's actually a good question, and it really made me think, and it's what really changed my culmination strategy completely. And what it taught me was patience. So like right now, the market is completely overvalued, and if you have $5,000 on the sideline, I would, without a shadow of a doubt, put that money in T-bills at this time. I believe that the stock market is completely overvalued, and I believe that we're due a pullback. I don't know when that pullback will come, but I just believe we'll have a pullback. So you'll be earning a decent return, with T-bills, 3-month T-bills paying about 5.34%. So you'll be making money off of that money. You won't be anxious. That's where I talked about patience, what it taught me. You could patiently wait for the next downturn. If that downturn comes and it's about 10%, you can start adding a little bit to your position. But as I said, like in October of 2022, I believe that the Federal Reserve had just started hinting that they was going to raise interest rates, or they started raising interest rates, and the stock market fell. And during that time, I believe it was about 22%. Now that's a really, really nice pullback, and there was no real economic reason other than a tax hike. And if it was me, when you get a pullback like that, that's your opportunity to go all in. I mean, if you don't have a stock that you're real strong on, I would always go with the SPY, which is the tracking stock for the S&P 500. I mean, you can't go wrong. That's 500 of America's best companies that's in there, that's within that S&P 500. Or you can also invest in the QQQ if you want a little bit more risk and a little bit more upside and a little bit more movement, far as percentage-wise, you'll probably get more from the QQQ. So if you're younger, you can probably go with that. And you do that if you don't have an investment idea. But if you have an investment idea, at 10%, you can start nibbling at it. But if you get down significantly, 20-something percent, I would go all in. And how that benefits you is now you got the equities that you like at a good fair price. And as I recommended in earlier videos, when you buy equities, you never plan on selling those equities. And so what'll happen in the future as the stock market turns and starts going back up, you just hold on to that position. You start saving new money, any new money. If the market, let's say if it's still down under 10%, you could put that new money to work in your equity positions. But let's say if the market goes through and start making new highs, I would start, and you're saving up money, I would start putting that money in T-bills. And all this is the exact thing is spelled out in the culmination. If the equity starts going up higher and higher, I would start selling some calls against my position. If you have 100 shares of the SPY, QQQ, or the position you own. So any money that you're earning off of dividends, off of selling calls because the stock is so high, and just saving up, you're putting that new money in T-bills, and now you're waiting on the next downturn. In my lifetime, and one of the main reasons why you go all in my lifetime, I had 99. I had the biggest downturn, 2008. And then we had the COVID downturn. So there's been three major opportunities that I was able to go all in. And then when you're down low, you make sure you purchase, as much as you possibly can, because those downturns only come around every once in a while, maybe once a year. Once a year we get a 10%, correction. You can start adding to your positions, but you really want to go hard and strong when you get that big downturn. Unless there will be times that even at market highs like right now, there's a stock out there for whatever reason is undervalued, and you can buy that. I'm not saying that you can't. I'm just saying if you're buying the overall market, you want to purchase at really good times.